You're watching Stockwatch. I'm Znati Guma, and joining me to unpack your stock-related questions today are Grant Nader from Benguela Global Fund Managers and Mutooni from Sanlam Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za or on SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thanks so much for your time, gents. I'm really starting off the show with complaints. I said we have to talk about Sasol, and I just heard, If it's not the viewers asking about Sasol, it's me. I'm very interested because what do you mean we're at 87 Rand? What do you mean we're at 87 Rand? Grant, I didn't think that we'd go anywhere under 90 Rand, but it has happened. And I mean, the question that we were asked last year is, do you think Sasol will go down? It has indeed gone down to 87 Rand. Your thoughts?
So this has been a classic value trap, and this has been one of those situations where it's looked cheap for a long time, but sometimes things look cheap for a reason, and they're not as cheap as they look. And so it's a really good example for investors to look at Sasol and learn. And what you've found is they've got a lot of structural headwinds in the business, things that they can't control around climate change and carbon emissions, the global chemicals market, etc. And then they've got internal challenges around the operations, around the management and sort of efficiency of what they're doing. Are they managing margins and cash flows? And so you've got challenges on all fronts, and they're not really even controlling the controllables, which are within their own world. So it looks cheap, but there's no real perspective or no prospect for things turning around outside of a sharp recovery in the Rand oil price or chemical prices and things like that. So those are the kind of businesses you need to be very careful of generally, unless you have a strong view on that macroeconomic driver that actually has nothing to do with the. So until you become highly constructive on oil, this might be too cheap here, but is it a great business, or is it something you should own and put away and sleep at night? I don't think so.
It looked cheap, and now it's gone even cheaper. My brother was actually telling me that he bought at 240 a while ago, and then he says he averaged out and bought more at 90 Rand. I don't know how he must be feeling at this point at 87 Rand. Roy?
It reached 100 like a couple of days ago, so
yes.
He had a chance to bank some profit on.
And that's the thing. So I feel like, Roy, is it a thing of any kind of good news in the long term? It's only good news for the short term, but in the long term, it doesn't really feel like they're going to catch a break for a while.
So I'll start by saying the same thing that you said. It's cheap. I mean, I'm just looking at it now. On 2025 earnings, it's trading at like 2.6 times on a PE. So optically, it's very cheap. But remember, this one, it's exactly like Grant says, value trap territory. And what's value trap? It's when the good news hammers it a bit, rather the bad news hammers it a lot, and good news it doesn't react to. So it started picking up because of all the talk about a listing and a higher oil price and everything. But the minute the production came out, it sold off. Remember, it's got a vast array of problems that it needs to deal with. There's a terminal value issue. Will they be allowed to extend their coal resources and reinvest in this whole just climate transition story? Or will they be allowed to separate themselves from the US? There's so much that needs to be considered here that I think the average investor just looks at it and says, step back. Somebody's going to make money. It's like the guys who bought it at $30 and were able to sell it at 400. Somebody's going to make money. I just don't know who. That's the thing. So you start from the perspective that, yes, it is cheap. Yes, it is a poor quality company. And the future is particularly cloudy for this one. So management's got a tall order. They have to correct the story. They have to come out with a distinct story. This is who we are. This is what we're doing. We're either in coal mining and converting that coal into petrol, or we're going to find somewhere fitting into this just transition, or what we're going to do is we're going to run ourselves into the ground and pay out big, large dividends and then sell the US business at a huge profit, and shareholders will win. I don't know which one of those stories holds. Management needs to sell it a lot stronger for for new investors to come in. And remember, the overseas investors don't need to invest in Sasol. They've got their own oil plays out there. So you're talking to local companies, local investors. Yes. So, yeah, as we've said many, many times, this is a complicated one, very cheap, but you have to be very patient and confident with this one.
Yeah, ne? Okay, talking about
Yeah,
yeah, that's literally no more words. Talking about oil, and actually, Roy, you mentioned that the overseas investors have their own oil companies and ETFs to go into. There's a question on that after Trump's inauguration and hearing his sentiments around oil, saying we're gonna drill, baby, drill. What is the panel's view on the following ETF or shares? Firstly, before I guess we go into those specific shares, what is your view basically on the oil market, Grant, and would you be investing in these oil stocks outside of South Africa?
This is a good question, and it's one, so oil at the margin is driven by the supply-demand balance in terms of pricing. And if you think about it, if the US ramps up and they drill, baby, drill, it's going to increase supply. That should actually bring prices down and somewhat put pressure on the profitability of these energy companies. But if we see this renewed growth trajectory, rates cut, et cetera, it could balance that equation. And so what I would suggest is look at something like oil services. So these are the guys that service the guys who put the rigs in the ground and the shale wells and all that. And so they're going to benefit from the level of activity rather than the oil price per se. And ultimately, the activity is dependent on the oil price, but in a broad range of $65 to $85, and they're pumping out oil, and there's a lot of activity. These guys are quite well positioned. So I think there's an ETF on that as well, one of the Van Eck ETFs. But so it's difficult to, oil companies make a lot of cash flow, and I think you're never going to lose money on one of the big majors. You'll be fine. But it's a difficult timing thing in terms of where oil goes from here. I like the oil field services play as my suggestion. That's
actually a pretty interesting one where you don't necessarily play the oil price, but you play activity. So the viewer had a few options here. What do you think of these ETF or shares? Imperial Oil, Range Resource Corp, United States Oil Fund, Precision Drilling Corp. Roy, I don't know how familiar you are with any of those, but would you be looking at any of these?
I think Grant has it 100%. The thing about oil, the oil price, it's supply and demand. Demand, largely because China is not growing as fast as it was growing previously, has taken a whole hawk out of that. And that's not been replaced anywhere by anybody else. Then on the supply side, you have Trump. You have places like Nigeria that were producing well below quota. I think they're producing like 1.2 million barrels a day. Now they're saying they're geared up to go all the way to 1.8, possibly 2. And everybody else. I mean, the Saudis need to produce oil to transform the economy. So the supply side is very clearly oversupplied. Okay? The demand side, we're not seeing where it's coming from. Global growth is below trend and is forecast to remain below trend. So that imbalance is going to remain whichever way you look at it. But like Grant says, the thing with oil drilling is you have to keep your activity going.
Yeah.
If especially like in the US, in the Permian, if you stop drilling, then those mines start filling up, and it becomes complicated. So you have to have activity, you have to maintain your machines, you have to keep drilling. So oil services is definitely a place to go. Anything like, remember the old Schlumberger that advises on development of oil fields and exploration, that's probably where you want to be. I'm not particularly familiar with any of those, but I think look for diversified plays where there's a lot of services, where there's a lot of equipment, and not so much the actual oil producers. I think that's how I would think about it.
All right. Well, there's a question now going into small company on the JSE, capital appreciation. Eyeing capital appreciation, though I'm still analyzing this company. So far, I like their competitive advantage in the payment software space. We haven't spoken about capital appreciation in a while. Grant, your thoughts there? So, yeah.
I like it. I like this little business. It's small. It's too small for us to own in our funds, but I think it's a good little business. There's a nice cash underpin as well. The point of sales terminal with software bundle type of thing works well. I think they're growing that estate nicely, and then I think they've also got this software as a service and consulting arm so they've got two separate businesses in there. One around the point of sales, one around the software, from what I remember. And I think that's a really nice avenue for two different type of growth trajectories. You've got the potential to benefit from AI consulting and adoption and deployment. So I think it's a great little business, and I would own it personally in my PA account if I could.
Yeah, all right. We'll talk about AI. Roy, I want to ask you a different question from the same viewer. I plan on buying some Satrix NASDAQ ETF, but I'm worried about the underlying overvalued stocks like Apple. I think this can be a long-term investment case going into a NASDAQ ETF at this point.
Well, the thing is, the scale of innovation that you've seen in those NASDAQ companies is immense, and over time it has evolved. But he's also right that the level of concentration has risen. An interesting way to offset that is to buy the equal-weighted ETF. So what that does is it ensures that the contribution from the big companies and from the small companies is about the same. So what you find is, if the market is rallying, if the NASDAQ is going up, your market cap weighted NASDAQ is going to outperform the equal weighted one. But when it comes down, the equal weighted one starts to outperform. Maybe that's a better way to diversify your interest while keeping an investment in that whole IT, AI sort of space.
Okay, that's an interesting take on it. There's one on Blue Label Telecoms. Is it worth investing in? Okay, there's something missing, but yeah. Is it worth investing in if it does not pay dividends? Roy, Blue Label?
Blue Label is a very interesting company, I must say. If you look at the pure Blue Label business, the original Blue Label business, it's a fantastic platform where you could buy anything. So it's the prepaid company, you could buy airtime, tickets, bus tickets, and all of that. And that's a very high return business, which in the US and other places, those sorts of platforms, they trade in the 20s, give or take. But they went out and bought Cell C, which has been a millstone around their neck for a long time. It's gone through a whole raft of CEOs, business strategies, capital and everything. Now they seem to have got their business model right. They're going to be this MVNO. They're going to support other companies that want to be MVNOs and all that. They don't have a network, so not much capex, but they still have to pay down the debt. So that's taking a little bit of time. I think in the fullness of time, this will be an attractive business model without the capex intensity of a third or fourth player mobile network operator. They don't pay dividends right now because they can't. So you have to be confident that you get the capital gain. And you've seen the share price move quite significantly over the past 6 months. And I think it's just the market beginning to understand it a little bit more. It's very difficult to understand the accounts because of all the consolidations and impairments around Cell C, but it's going to clean up over the next 12 months. I think it's one well worth keeping in touch with.
Before I get to Grant, just on Blue Label, because I remember reading that they also want to increase their stake in Cell C and basically integrate it into the business more. Is this a good thing?
So the reason they want to do that is they currently call the shots there.
Yeah.
Pretty much. They're the biggest investor. All the other guys were people who changed from debt to equity. And it's true, they're not contributing anything. So what these guys actually want to do is consolidate it, which also simplifies the reporting and makes things a lot more transparent. They are driving the strategy there. They've agreed the strategy with Cell C. So it's more about ensuring that you're getting bang for your shareholders' money. I think it's a wise thing to do.
Okay, all right. Well, Grant, is it wise to short We Buy Cars? Because there is a viewer that is asking for your view on shorting that company. Quite a lot to say, but basically seeming that he's not a fan of We Buy Cars.
Okay. So don't confuse whether you like a company with whether it's a good short.
All right. Okay.
Yeah,
Okay.
shorts are quite dangerous. I think We Buy Cars is a good business. I think they've developed quite a powerful platform, and they've got a real network effect that's gaining traction as it grows with time. But having said that, it doesn't mean it's not you might find it's a trading short. It's done 110% since it's listed. It's certainly had a frothy run. It's probably a bit rich at these levels, but you need to be shorting is a tactical. It's a trading mechanism. It's not a fundamental. You must be careful. I don't think there's a fundamental flaw with this company. If you're going to short it, you need to just look at it from a technical point of view. Have a stop loss. Also check that there's enough free float. So a lot of these smaller companies, they're illiquid. You can't even borrow stock, and maybe there's only a few people that can borrow stock. And what that means is there's not a lot of sellers around and natural sellers, and so you often don't have support for even if your view is right. So it's difficult shorting little businesses like this that are not highly liquid and not widely owned, and don't have a strong two-way flow of buyers and sellers. So I mean, by all means have a trade, but be careful. I don't think fundamentally there's a reason to short this business.
Well, I mean, Roy, it has actually had quite a run. I remember last year, I mean, I haven't really checked the graphs this year, but I would imagine that it has remained at elevated levels. At this point, because it's also run, I guess, pretty hard. Well, actually, no, it's flattened out a little bit. Yeah, your thoughts on actually how it's run, and what investors, what would be the wise decision to? Is it even wise to let go of the stock if you are already in it?
The first thing to start off with this one, like Grant says, I think it's a fantastic business model. They've cornered it. They're going to be the biggest player there. They will call the shots in that industry. It's now it's a 20 billion rand company. So it's not a small business. But remember, it was only listed very recently. You had, I think it was Coronation who bought a significant chunk. And I think some of the institutional managers have been accumulating until since then. And that was probably what underpinned the share price, the rapid rise in share price. Like Grant says, low liquidity at the time, people want the shares, people like the story, they're willing to pay up. Over the short to medium term, it's very clear the used market is growing a lot faster than the new market, which is a little bit contradictory, but because everything comes through the new market, it just says that you have more transactions on the used side, and that's where they make money. And over the next few years, that trend is probably going to continue, even taking into account the Chinese. So I think solid business model, very good conservative management. I struggle to see why you want to short it. You have such significant event risk here that shorting it, you have to be confident the accounting is poor, or something's going to go wrong, or they're overstocked with bad cars or something like that. You really need to be very careful with that.
Okay. We'll talk about things going wrong. Lots of things went wrong at Transaction Capital. And there's a viewer asking, transaction capital down 23% in the last 6 months. A panel's view. Is there anything left, Grant, for you to be interested in at Transaction Capital?
So I don't follow it that closely anymore. I know that they've transformed into that. It's predominantly that Nutan business, which is the sort of services and outsourcing and debt collection to a large extent, I think. And I think that's not a bad business model, but I don't know within the context of Transaction Capital if it's a great business and if you're paying a great price. And I don't know to what extent the legacy that they're trying to carve out and move away from is still hindering management, their focus, and the growth opportunities. So unfortunately, I can't add too much more than that. I would tend to just stay away from it because there's not enough clarity on what the runway and what the business looks like for me.
Yeah. Roy, life of Transaction Capital after We Buy Cars?
Well, the thing is, I think what you're seeing here is the clientele effect. People invest in Transaction Capital because of taxi and We Buy Cars and exciting stuff there. SA Taxi went down, We Buy Cars unbundled. Then you're left with this little business, which might be a fantastic business, but it's a much smaller business We don't understand it. I think management has become quite gun shy in this transition to go out and actually actively market it to shareholders. So it's one that will just become small and ignored over time, apart from the few who actually understand what Newton does. So, yeah, I mean, look at that 23% down as part of the transition to a new business. Not so much people selling out because earnings were down or anything of that sort. People are moving on to other growth opportunities.
Yeah, all right. Well, another one that people don't really talk about, and I guess it adds to the viewer's comment on that. It says, I do note that it is quite thinly traded. Sygnia. Would Sygnia be a good long-term 6-year plus buy, Grant?
I like it. I think this is a good little business. I think they've grown well. They have, they have assets under administration, so they administer funds, and then they also have their own funds that they manage, and they have this ETF suite of ETFs that's actually competing well. They're quite innovative in the kind of ETFs they're listing. They've got one or two active ETFs as well. I think it's a good business, and I think they've done a good job so far. I think they'll continue to do well, and it's a growth industry, so a lot of money is moving into the kind of strategies that they offer, whether it's passive investing, ETFs, etc. And I like it. I think it's a good business.
Yeah, I mean,
and it's not particularly expensive as well. I think
yeah.
you're getting it at very attractive multiples at current levels.
I mean, on it being thinly traded, the viewer is also asking, will that change? Roy, do you see that changing anytime soon?
It's another one that's dominated by its founders. Just remember, with these asset management businesses, you need a growing economy and a growing savings pool for it to, over time, actually grow. So what you have right now is they're consolidating. We are all competing for these assets. And when somebody gets assets, it means somebody else lost. It's not because a company started and people started contributing, and because there were more attractive assets, more attractive products, you got cash. It's a slow growth industry. You've seen it with Coronation, you've seen it with Allen Gray, you've seen it with, all listed asset managers. So I would say from Grant's perspective, I agree that it's probably cheap, and the way they've grown for their niche, they've done really well. But just be aware that active asset or passive management business model is actually a mature business model. We need to see substantial growth for it to come into fruition.
All right. We'll talk about fruition, gents. Where are you seeing that? What are your stock picks for today? Grant, starting off with you.
Right. So my pick is Accenture. And I think everyone knows about the AI excitement and the AI wave. And we know the CapEx rollout, data centers, infrastructure, all these models being built. But what do you do with all of it? Right? The next wave is companies. There's not a company in the world that's not thinking about, how do I use AI? What am I supposed to be doing? And even if I want to use it, how do I use it? How do I go from where I am to there? So that's where the role of a consultant comes in. They help them organize their data, structure the data, label the data, get it into a position that they can use it. And then they go, okay, how do we use it? And so there's a huge role to be played by these global consultants in transitioning the world into AI adoption and evolution. And so I think this is one of those companies. They're one of the largest in the world that's going to tap very nicely into that trend. And I think they've got a good runway for growth in the next few years. So that's my pick, Accenture.
All right. Roy, what are you betting on today?
I'm betting on Telkom. Telkom's it's one of those ignored telecom companies, but I think if you look at what they've done in the past 1 year, they've cleaned up their portfolio quite significantly. Sold off the towers portfolio, the cash is going to come in, that will sort out their balance sheet. They don't have to invest that much in OpenServe, already the big player in that fiber market. And then on mobile, they're growing service revenue in double digits when MTN and Vodacom can only grow in mid to low single digits. So they've got a strong niche. I think the management team has hunkered down. M&A is behind them. You should see them start paying dividends in a year or so, and the gearing issue is behind them. I know people talk about BCX and the problems it's had. I don't think it's getting any worse. It's probably going to hold up there. But I think when you look at Telkom from where it's trading now from a valuation perspective, I think that one offers value for the patient investor.
All right. Well, thank you so much, gents, for your time and for your analysis today. Much appreciated. That is all for tonight's Stock Watch. Thanks to our guests, Grant Nader from Benguela Global Fund Managers and Roy Mutooni from Sanlam Investments. Up next, The Close. Stay with us.